Hey everyone, welcome back to SoundView's monthly market recap. I'm Misty Lynch, and happy August. It's my favorite month of the year, and we are officially in the dog days of summer, and the markets have been giving us plenty to talk about. This month, we're covering a lot of ground. We'll do a full July market recap, zoom out on the first half of the year, since we're well enough into the second half to have a good perspective, and then spend some time on something that everyone's been thinking about right now, the Fed's decision last week to hold interest rates steady, and what that means for you and your borrowing costs, especially what it means for real estate. And we can also finish with a look at what the Magnificent Seven is doing and where they stand, because that story's gotten very interesting. So let's get into it. So for July, the headline is this: it was a tough month for tech-heavy indexes, but a resilient one for the broader market. And that divergence tells you quite a bit about where we are right now. For July, the S&P 500 slipped just 0.1%, the NASDAQ declined 3.2%, but the Dow actually bucked the trend, edging up 0.3% to its fourth straight record monthly gain. Now, those month-end numbers don't fully capture how dramatic the month was. The NASDAQ 100 fell approximately 7% in July. That was its steepest monthly decline since March of 2025. And this was weighed down by some uncertainty surrounding the war in Iran, volatile oil prices, and a hawkish Federal Reserve, and a sharp semiconductor sell-off. But what's most important is the month ended on a very strong note. U.S. stocks rallied sharply on July 30th, rebounding from the prior date's Fed-related sell-off, with Microsoft and the semiconductors driving the gains. The NASDAQ composite finished 2.8% higher, ending a six-day losing streak, while the S&P 500 climbed 1.7%. And then, on the final day of the month, investors looked past the rising bond yields as Amazon shares jumped, with the NASDAQ rising 1%, the S&P 500 adding 0.7%, and the Dow gaining 277 points to close at 52,485. Amazon jumped 15.3% on strong cloud growth. Optimism around AI and trade boosted software and hyperscalers, with Alphabet gaining 6.9%, Microsoft adding 3%, and Meta rising 3.3%. These gains were then offset by a decline in Apple, which fell 7.3% after chip shortages and raising costs reduced their June production. So the month started ugly, got uglier mid-month, and then ended with a burst of energy. Classic 2026 volatility. Also, let's revisit the first half of the year, because the context around all of this matters. The stock market surged over the first half of 2026, shrugging off a war in the Middle East, historic oil shortage, and a fear of bubble in the AI sector. The Dow Jones is on pace for its best first half since 2021, climbing 8.9% to top 52,000. Over that same period, the S&P jumped 9.4%, and the NASDAQ tech-heavy soared 12.5%. So overall, this first half of the year has kind of been fueled by earnings. Many shoppers are willing to spend despite elevated prices. And secondly, the AI infrastructure spending boom. The top mega cap developers are now expected to commit $723 billion on an AI build-out alone. And third, the labor market added a pretty robust average of 114,000 jobs each month from January to May. The most important twist, and we'll come back to this when we talk about the Magnificent Seven later, is that for 2026, the overall equal weight S&P 500 climbed more than 13% against an 8.5% rise for the standard S&P 500, closing some of the performance advantage that we've had with mega stocks. And that's actually a healthy sign. That means the breadth is expanding and more of the market is participating. All right, so the big moment of the month happened on July 29th. And if you haven't heard, the Federal Reserve met and decided to hold rates steady. So I want to break down exactly what happened and what that means for us. The Federal Reserve voted to hold rates, a 9-3 vote, between 3.5 and 3.75. Three regional presidents, Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas, dissented, as inflation has remained above the Fed's 2% target for more than 5 years. This was the fifth consecutive meeting where the Fed left rates unchanged. And there was an unusual lack of clarity about the Fed's next move, as the economic outlook remains clouded by conflicting signals and a lack of guidance from the new Fed chair, Kevin Warsh. Now, here's the thing about Kevin Warsh. He's made a very deliberate choice to remove what the Fed calls forward guidance. His decision to keep the Fed away from tipping its hand about how rates may change in the future means that the markets have to pay more attention to the economy and less attention to the Fed's hints and winks. Although the Fed didn't raise rates, higher bond yields may have helped do some of the Fed's work for it, restricting some lending, keeping inflation somewhat in check. But what Warsh did make crystal clear is that inflation is the top priority. And Warsh said the move to hold rate steady was especially prudent at these uncertain times, while emphasizing that the Fed doesn't have a soft or implicit inflation target. He said, "Not one of my FOMC colleagues is under any illusion that we've begun a new chapter. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities." So, what's next for rates? Elevated inflation, primarily stemming from higher energy prices, has increased investor expectations for higher policy rates later this year. Investors now anticipate between 1 and 2 rate hikes by the end of 2026. The next Fed's FOMC meeting is scheduled for September 15th to 16th. Ahead of that meeting, Warsh is expected to speak at the Jackson Hole Economic Policy Symposium in August, and that speech will be closely watched for signals about September's decision. So I'll mark that on my calendar so you don't have to. Jackson Hole has historically been where the Fed sends important signals. JP Morgan Wealth Management continues to believe that a lack of bargaining power from the U.S. employees, as well as the base case for no further escalation in the war with Iran, will keep the Federal Reserve on hold through the end of 2026. But with 3 dissenting votes and stubborn inflation, that view is not, without risk. So let's talk about the part of this that affects all of you: real estate and borrowing costs. Because the Fed holding rates doesn't mean your mortgage rate is holding steady. These two are different. And the thing is that one of them, it's kind of misunderstood how these concepts impact personal finance. The Fed's benchmark rate influences a wider range of consumer borrowing saving costs, including mortgages, credit cards, car loans, and deposit rates, while short-term rates are closely pegged to the prime rate. 15 and 30-year fixed mortgages don't directly track the Fed's benchmark. They do follow the lead with long-term treasury rates. And right now, those long-term treasury rates are moving in the wrong direction. The 30-year treasury bond spiked to its highest level since 2007 last week. This is sitting around 5.25%. The benchmark 10-year treasury note yield topped 4.7%, its highest level since January 2025. So what does that mean for the mortgage level? The average 30-year mortgage fixed rate now sits at 6.58% as of late July 2026. The 30-year mortgages have crept past 6.75 at various points throughout the year due to the Iran conflict. Mortgage rates have already moved near a 1-year high with renewed tensions in the Middle East. Good news for prospective borrowers is that Fannie Mae's June 2026 housing forecast projects that the 30-year fixed mortgage rates will hover around 6.4 for the rest of 2025. The MBA forecasts 6.5 in Q3 and Q4. A Reuters poll predicted that rates will decrease a bit through the year and end at 6.4, and in Q3 be 6.3. The housing market itself, existing home sales pulled back to June to a seasonally adjusted rate of 4.09 million units, with sales falling 4.2% over the first half of 2026. Median home prices hit an all-time high of $440,600 in July, up 1.8% from a year ago, according to the National Association of Realtors. And homeowners locked into low pandemic-era mortgage rates are very reluctant to sell because they can't transfer those affordable rates to a new property. The current mortgage rates hovering around 6.6%. That's going to make the average financial cost of moving prohibitive for many, many people. So my takeaway for anyone thinking about a large home purchase: if you're buying, rates may ease slightly in the second half of the year, but don't bet on a dramatic drop. Buyers will be able to access mortgage rates with similar to those in the past 3 years. And while today's rates are higher than pandemic-era lows, they're much closer to historical averages. Date the rate, marry the house is still an okay mindset. You can always refinance later on when rates come down. And I think at some point they will. For auto loans, HELOCs, and credit cards, Most credit cards carry variable interest rates tied directly to the Fed's benchmark rate. And with that rate holding steady, credit card APRs are also likely to remain elevated. If you're carrying high interest consumer debt, pay that down aggressively if you can. No rate is going to come and help you there. So, finally, let's talk about the Magnificent Seven, because the story here has been flipped dramatically from what we knew in 2024 and 2025. The Magnificent Seven is no longer a monolith. The high-flying tech stocks that congealed into a single investment thesis, representing the phase of the AI trade, are differentiating in a major way. More telling, the group is now underperforming the market as a whole. In 2026, the S&P 500 is up about 9%, while the group is down about 1%, according to an analyst from Vanguard. So let's look at the individual stories. As of late July, Apple leads the pack with strong year-to-date rally, while Microsoft and Tesla remain in the negative territory for the year. Apple and Alphabet have held up best within the group. Nvidia stock has slowed this year after a staggering 1,177% gain in the past 3 years through 2025, but it's still risen roughly 9.5% in 2026, roughly in line with the broader market. Then, just this past week, we got Q2 earnings from several of them, and the results were wildly divergent. Microsoft shares jumped 16% after reporting 43% growth from its Azure cloud business. Amazon surged 15.3% on strong cloud growth. Alphabet missed earnings while boosting its 2026 CapEx forecast by $15 billion. So here's the bigger takeaway. The more diverse group of infrastructure builders, energy companies, and chip makers have started to steal the thunder from the AI trade. Vanguard identified 45 companies with a broader AI complex that has doubled in value since the beginning of the year, notably excluding Alphabet, Amazon, Meta, Microsoft, and Oracle. The Magnificent Seven have fallen out of favor as a group, but they still dominate earnings. Wall Street sees big tech names growing earnings 31.1% year over year in Q2, outpacing the rest of the market by almost double. So the fundamentals are still there. The question is whether investors will pay the premium for those valuations for them. So let me bring it all together. July was a volatile month. The Fed held rates, but made it very clear it's not afraid to hike. The Magnificent Seven are no longer moving as one. We need to look under the hood. And if you're thinking about buying a home or making a large purchase, the best advice I can give you is to plan around today's rates, not the rates that you're hoping for. The most important thing through all of this is for us to stay invested, stay diversified, and stay focused on long-term planning. Markets are going to be noisy throughout September. The Fed meeting, Jackson Hole, and Q3 earnings are all going to create headlines. But we don't want to let the noise drive our decisions. As always, if any of this raises any questions specific to your personal situation, our team is here to help. Reach out to us because that's what we're here for. Thank you again for watching, and we'll talk again next month.